Today's highlights. Can institutional investors in Bitcoin withstand the selling pressure from Asia? Ethereum's popularity is sluggish. Is it gathering strength, or will it have to endure more pain? Tom Lee keeps calling for a double, while BlackRock is hitting the brakes. So is this round of the market heading up, or is it about to reverse? The FDIC has put a safety lock on stablecoins, and now stablecoins are about to split into two parts. December 18th, Thursday. This is the BitcoinTV Chinese channel. Be united. I'm Michael. If you want to keep up, you have to watch 24/7 and stay on top of your data headlines. Now, let's look at the current price of Bitcoin. We still need to focus on it because it just can't seem to go up. What's the real reason? We've always thought it was because American institutions were cashing out and leaving with their money. But if we look at the Coinbase Premium Index, it's either at a positive premium or close to neutral. So according to this index, ETF and institutional money hasn't left. In fact, it's slowly coming in. So, from the demand side, there's nothing that's really preventing the price from going up. What is it then that's actually holding the price back? There are just too many sellers. So where is this selling pressure coming from? Let's take a look at Binance, Bybit, and HKEX. These are the main battlegrounds for the Asian market, right? For 4 consecutive quarters, these exchanges have been selling spot almost every day. The selling pressure is very real and has been keeping prices down. So what's even more intense now? Miners are also selling. The reason is simple. They have to pay for electricity and operating costs. If they don't sell their coins, they have to shut down. Right now, it's really becoming impossible for them to survive. So this kind of selling pressure isn't because I'm bearish or pessimistic about the future. It's really just that there's no money left and they have to secure their current position first. Right now, this is a phase of rigid supply, but it's also an especially grueling period. But what's subtle about it? Some of the old holders in Asia are also starting to loosen up now, beginning to distribute their coins that were originally acquired at very low prices. Under the current macro and regulatory uncertainties, they're starting to allocate some of their holdings, and a portion has been sold. Historically, this situation isn't uncommon, but what's the picture at this stage? On one side, US institutions are gradually taking over, while on the other, Asian sellers and miners continue to offload their coins. So, during this phase where buying demand is absorbing the forced selling, it's unrealistic to expect Bitcoin to take off before this process is complete. It's not that there's no demand for Bitcoin right now, but rather that the sellers haven't finished selling yet. Where is the real turning point? It all comes down to one thing. When will these involuntary sellers be cleared out? Alright, everyone is asking how the altcoin season will arrive. To understand the altcoin season, you have to look at Ethereum. To put it bluntly, right now, hardly anyone is coming to Ethereum. Why do I say that? The number of active Ethereum addresses has dropped to around 170,000, which is the lowest level of active addresses on Ethereum in the past year. So retail investors are basically in a state of lying flat. The previous period of sideways movement lasted too long, and the rally lasted too long as well, which has really worn people out. So it's normal for short-term traders to exit. But this isn't a case of both retail and whales dumping and running away together. It's more like everyone is waiting to see when this selling pressure will be absorbed and when new buyers will come in. So the current situation for Ethereum is this. The selling pressure in the market is actually not that great anymore, but there's also no new buying force to push the price up, so the price can only hover around this level. Historically, this stage often appears, but it usually means the calm before the storm. What about medium to long-term capital? It's often in these quiet market conditions that smart money slowly starts to position itself. This is a signal to enter the market. So, when the number of addresses starts to climb again, that's when Ethereum's price will find its footing. Before the number of active addresses recovers, it's very likely that this kind of market will continue to test people's patience. Alright, let's take another look at Ethereum. Right now, with Ethereum, everyone is basically moving their coins off Binance and back to their own wallets. According to on-chain data, the proportion of Ethereum supply on exchanges, this ESR, has already dropped to 0.137. This is the lowest range since 2016. The meaning is clear. There are fewer and fewer spot tokens available for dumping at any moment. Let's look at another key data point. Binance's Ethereum ESR is 0.03. A large amount of withdrawals are still continuously flowing out of Binance. What does this indicate? It shows that when it comes to Ethereum, people aren't looking for opportunities to sell, but rather to withdraw first to transfer to their own wallets and not leave it on the exchange. So the price action is also quite interesting. As you can see, Ethereum dropped below $2,800 today, right? It didn't suddenly take off just because the supply decreased. But this drop can't really be called a panic sell-off. It's more like quietly digesting positions and rearranging the seating order. Simply put, that's what it is. In the short term, Ethereum will probably continue to fluctuate and consolidate between $2,600 and $3,000 for a while. But in the midterm, whether Ethereum's price can break out is no longer just about selling pressure. It really depends on when companies like Bitwise are willing to start buying Ethereum ETFs with real money. Please like and turn on the notification bell. We're here to help you sort through the most important news in the Web3 world. Our show has been broadcasting daily for 6 years now, and when it comes to topic selection, we actually lean towards a macro perspective. We focus more on policy-related topics, because our main audience is actually people from Web 2 who want to enter Web 3. We want to introduce everyone to the real crypto world. The crypto world isn't the kind of get-rich-quick myth your neighbor tells you about, where you make 8 times your money in a day and achieve financial freedom in half a year. There is regulation, compliance, and real builders here. It's a process of gradual understanding. So for our news headlines, we still need to pay attention to the price of Bitcoin. Recently, Bitcoin has pulled back again, and many people who are not firm or who lack understanding of the crypto world have started to question it, saying, is this the beginning of another scam? As soon as the price drops, it's called a blockchain scam. As soon as it rises, it's a Bitcoin revolution, right? So, will Bitcoin go up or not at the end of this year? There's only 1 week left before the year is over. So, what's the current macro environment out there? Nothing is calm. There are a lot of issues, both economically and geopolitically. The internal structure of the crypto circle is also being reshuffled, so naturally the price can't move up quickly. On one hand, some early players are loosening their positions, with some selling at high prices to cash out and improve their lives, right? On the other hand, institutions aren't in a rush to bottom fish with ETFs either. They're entering slowly, bit by bit. This isn't a sell-off, nor is it a pump, but it's an extremely intense rotation of hands. Many retail investors can't understand this point. You have to realize that buying when no one cares and selling when everyone is talking about it sounds simple, but actually doing it goes completely against human nature. Since the Bitcoin halving in 2020, we haven't seen anything on this scale. The real issue now isn't whether the price will go up or not tomorrow, but rather when these old chips, the decisive chips in the hands of retail investors, will be completely sold off, and when the institutions, when will they feel they've accumulated enough and start to push up the price? Once these two things align, the answer will naturally reveal itself.
K33. Research released a report on December 16th pointing out that long-term holders who have held coins for more than 155 days, the 2-year selling cycle is nearing its end. Since the beginning of 2024, about 1.6 million bitcoins held by long-term holders have been reintroduced into the market, significantly increasing selling pressure. The market is approaching a key turning point.
Are beginning to actually recover. That's why I think Bitcoin could double from here by the end of January. Now, many people don't expect this because of the 4-year cycle. And that's going to be the big question. If Bitcoin breaks 125,
K33 researchers' report points out that in the past 2 years, more than 20% of the long-term holders' Bitcoin supply has completely changed hands. On-chain selling pressure is approaching its natural limit. The model shows that the current 2-year holding supply of about 12.16 million coins is likely to end its downward trend and may rebound above the current level by the end of 2026.
K33 Research is a Norwegian company, and their claim to fame was accurately predicting the lowest price point for Bitcoin in 2025, believing it would surge past 100,000. Sure enough, their research report was cited by outlets like CoinDesk and many institutions, and their prediction of the Bitcoin bull market came true. So this time, K33 is once again talking about the storyline for the crypto market in 2026. It's very likely that the main character is about to change. Now, as these old OGs, old whales and veteran players have almost finished selling, the spotlight will shift toward regulation, policy, institutions, and even nations. So once the legislation is in place, right now, Bitcoin spot ETFs already hold over 850,000 Bitcoins. After that law is enacted, their prediction might even add another 0 to the number. All right, let's talk about stablecoins. They're the anchor of the crypto world. Whether prices can rise depends on if the total amount of stablecoins is decreasing, right? As of today, the total volume is $160 billion. So this is no longer a niche toy for crypto enthusiasts. It has already entered the traditional financial system and become an indispensable component. In July, the Genesis Act in the United States will officially come into effect. Why is the US in such a hurry to pass stablecoin legislation? because they know that only by pegging stablecoins to the US dollar and US Treasury bonds can the United States government continue to keep a firm grip on digital assets. But how this legislation will actually be implemented still depends on whether the local policies of each state can support it. It depends on the stance of the Federal Reserve and how the Office of the Comptroller of the Currency, OCC, implements it. Also, the Federal Deposit Insurance Corporation, FDIC. Their stances depend on company cooperation. These factors determine if stablecoin law is enacted. So who was the first to step up and respond in support? The Federal Deposit Insurance Corporation of the United States, in effect, is telling everyone that stablecoins are no longer just a slogan. They have already started to enter the practical implementation phase.
They are formulating implementation details for the Genius Act to ensure stability and avoid risks, a key firewall rule. Banks are prohibited from directly issuing stablecoins. Operations must be conducted through subsidiaries individually approved by the FDIC. The approval process is clearly defined. Confirmation of material completeness must be achieved within 30 days, and the review must be completed with a conclusion given within 120 days. Regulatory focus is concentrated on 3 points. Stablecoins must be 100% backed on a one-to-one basis by high-quality liquid assets. Rehypothecation and misappropriation of funds are strictly prohibited, and monthly audits and disclosures are required. At the same time, stablecoin issuers must provide a clear and timely redemption mechanism, and any fee adjustments must be announced at least 7 days in advance to enhance transparency and predictability.
So, with this move by the FDIC, stablecoins are essentially split into two categories. In the future, there will be two types of stablecoins. One is the kind that only big players like JP Morgan Chase and Citibank can handle, stablecoins with strict one-to-one redemption backed by regulatory support. And the other type? This type may look compliant on the books, but it still lacks sufficient transparency. These are stablecoins supported by market consensus. So, on one hand, you have bank-level or institutional stablecoins, and on the other, you have retail-level stablecoins. But regardless, if stablecoins are to enter the mainstream US financial system in the future, it will still be up to the US government to set the rules. So with this division, which side do you stand on? Let's speculate a bit about the future. If on-chain, there really emerges a so-called algorithmic stablecoin, one that's pegged to all on-chain assets and calculated by algorithms, which one do you think is more appealing? There are legends of getting rich overnight here, and there are also carefully scripted scams. This is a dark forest of chaotic development, but it also nurtures the spark of hope leading to the light. The destination of faith is freedom, and the end point of consensus is equality. In this episode, TV will guide you through the fog to see the future, and together we'll gradually become wealthy. With policies paving the way and clinging to BlackRock and Binance, can this wave capture the second largest crypto market in the US? With policies providing support and SEC changing leadership, is the crypto world seeing light at the end of the tunnel? At the recently concluded Binance Blockchain Week, BBW, you can think of this as Binance's global PR event following the big dip on November 11th. Of course, Binance has now checked in at Abu Dhabi and obtained a more compliant license. But in my view, the most important ally for Binance should be the United States. In October, Trump pardoned all of Changpeng Zhao's crimes, so right away Zhao said he wanted to turn the US into the crypto capital. But before he even finished saying that, the market set him up.
She said that the president had, quote, exercised his constitutional authority by issuing a pardon for Mr. Zhao, who was prosecuted by the Biden administration in their war on cryptocurrency. One thing to note as well is that as part of this lobbying campaign, this could potentially pave the way for Binance to continue operating in the United States.
After this point, Binance is re-strategizing its approach to the U.S. market. According to sources cited by Bloomberg, in order to overcome regulatory hurdles, Changpeng Zhao may consider reducing his shareholding, as his ownership structure has long been seen by U.S. regulators as a key obstacle. The relevant restructuring plan has not yet been finalized, but discussions are already underway. At the same time, Binance is reaching out to local U.S. entities, including asset management giant BlackRock, as well as the decentralized finance platform Words Liberty Financial, which is associated with Trump, in an attempt to leverage local resources to re-enter the U.S. market, the world's second largest crypto market.
I wonder if anyone has picked up on the underlying tone in this news. On one hand, as they say, I'm willing to reduce my stake, and on the other hand, Trump has been pardoned and things are proceeding as usual. The Democrats immediately exploded. Elizabeth Warren came out swinging, saying this is blatant corruption. Mark Z. Worcester was even harsher. He called out this money for power deal by name, making it clear that this is giving the crypto industry a backdoor and at the same time lining your own pockets. At this point in American politics, it's no longer just a question of pardons, it's a direct showdown between the new forces of the crypto world and the old guard of regulation. But Binance's reality is clear. If it wants to gain a firm foothold in the US, it's not something that can be solved by a few collaborations or a couple of restructurings. In the end, it all comes down to how deep your roots are in American politics, whose mouths you've managed to silence. There are less than 10 days left in 2025. Will you miss it? I won't miss 2025 at all. Even though we've achieved a lot, we've also gone through many black swan events. We've already been criticized to the point of being riddled with holes, but when B comes out to speak, we're still very willing to see that B's narrative is no longer just about whether prices will rise or not. Many people who predicted year-end prices have ended up embarrassing themselves, but I've always thought, so what if you get embarrassed? Any channel that refuses to predict prices is just playing games. The most important thing about price predictions is to give everyone confidence and to provide the market with a sense of future trends. Aim high and you might at least get the middle. But now, the crypto world's trend isn't just about prices rising. After the US election, Bitcoin rose 25%, yet many institutions refuse to admit defeat. They say there's a 53% chance Bitcoin will surge to $150,000. Now, it seems like the chances are almost slim to none, but the real focus isn't on the candlestick charts anymore. What's the truly significant change? In 2025, for the first time, policies will stop disrupting the market. After Trump took office, you saw that a digital asset task force was immediately established, with David Sachs leading the team to roll out over 100 policies and recommendations in one go. They clearly defined the boundaries between the SEC and CFTC and conveniently sent Gary Gensler packing as well. This extremely annoying person, right? In short, the crypto world used to operate in the shadows under US policy, but this year it's been allowed, recognized, and written into the system. So the crypto industry has moved from the basement into the living room.
After SEC Chairman Paul Atkins took office, he quickly adjusted the regulatory direction, launched a crypto project plan, reclassified most crypto assets outside the scope of securities, and established a 4-tier classification system including digital commodities and collectibles. At the same time, several major lawsuits against Coinbase and Binance were withdrawn. With the repeal of SAB 121, U.S. banks are now officially allowed to conduct crypto custody business. The U.S. intends to establish a national-level Bitcoin reserve. Coinbase became the first crypto-native company to be included in the S&P 500. Vanguard Group opened crypto ETF trading, covering approximately $11 trillion in assets. The Genius Act provided a regulatory framework for stablecoins, and the Clarity Act passed in the House of Representatives. Solana and XRP ETFs were launched one after another, marking a historic shift in the industry's policy environment.
I think this cycle is going to last much longer than people expect. I definitely don't think this pullback is the end. I believe 2025 will be a great year. I think 2026 will be a great year. I think 2027 will be a great year. And we'll see about 2028.
Now, the crypto space isn't driven by sentiment like it used to be. These days, everyone is focused on building infrastructure. RWA, for example, has gone up about 235% in a year. There are $100 billion more in stablecoins than there were a year ago. This isn't just a concept. This is real, tangible money. Robinhood, for example, is a U.S. exchange that's directly bringing stocks onto the blockchain. NASDAQ is going even further. They're even researching tokenizing stocks. The key point is the SEC's approval. Even prediction markets, once criticized as operating in a gray area, have won their lawsuits. They've also been granted innovation exemption policies, so it's all green lights ahead. So legislation will always lag behind market innovation. The key question is whether this legislation is meant to restrict or to encourage innovation. These are two fundamentally different paths of development. That's why whether this bull run in the crypto space is strong or not really isn't what people should be focusing on right now. Instead, we should be looking at how quickly the overall environment is moving towards mainstream adoption. Can you feel that the temperature of the crypto market is completely different from the last bull run? You're still hoping for it to drop from $69,000 to $15,000. Stop dreaming. Just hurry up and get on board.
This is a realistic situation. On October 7th, SpaceX's Bitcoin holdings hit $1,030 million on paper. It looks like a tech company, but it has casually become a crypto whale. Then, as soon as the market corrected and they did the math, more than $300 million had quietly evaporated. The base app now has tons of people who want to use it, but only a few can actually get access. Coinbase is still sticking to an invite-only system, slowly releasing spots, and as a result, over 1 million people are patiently waiting in line to get in. Recently, Trump made it clear that the next Federal Reserve chair will be announced soon, and there's only one criterion for the candidate. Someone who dares to cut interest rates will actually cut rates and is bold enough to set strong expectations. To put it plainly, this means the Federal Reserve might be about to completely change its approach. The old routine of talking tough but acting cautiously is very likely to be thrown into the dustbin of history. On December 18th, China's Ministry of Public Security's Cybersecurity Bureau reported the Qianan, Guizhou Cybersecurity Department, in cooperation with Economic Investigation, cracked a virtual currency pyramid scheme case. The Special Task Force went to multiple locations to make arrests, successfully apprehending 15 criminal suspects. This year, Bitcoin's volatility has actually been lower than Nvidia's, something no one would have believed a few years ago. To add insult to injury, it's said that this isn't just a flash in the pan. There's a high probability that this trend of a closed loop will continue into 2026, with the heartbeat gradually slowing down.
It's good to go through this. Our weekly reviews are actually about using simple methods to repeat, repeat, and repeat again, helping everyone build your market intuition, helping you establish your own strategy, and set your discipline. Why is this so important? Because in the crypto world, if you don't have a strategy, a plan, or a system, you'll definitely be led by the nose by the market and completely swayed by the news. When the price rises, you chase. When it falls, you hold on. Letting your emotions dictate your actions and relying on luck to determine profit or loss, this is a recipe for disaster. So true experts never act on a whim. They've already set their rules in stone and etched them into their hearts. When to enter, when to exit, what to do if they're wrong, and how much to earn if they're right. They never fall in love with the market. They just follow their system, watching the market, the price, and the trend, to decide whether to buy or not. This might seem cold-blooded, right? But actually, it's the safest way, because the purpose of a system isn't to make you win every time, but to minimize the chances of making foolish mistakes. And the value of discipline isn't to make you rich overnight, but to ensure you can survive when the market is at its worst. What the crypto world lacks isn't opportunities, but the patience to hold on until the next opportunity comes. Remember this, a system helps you make money when the market is good, while discipline keeps you alive when the market is bad. If you get what I'm saying, give this a like. Here, we offer our membership benefits, including access to our weekly reviews every Monday. Let's work hard together and slowly but surely become wealthy. See you tomorrow.